Welcome to our channel on accounting lessons with worked out problems. Brought to you by an experienced accounting professor with a CPA. We have videos on all topics of introductory financial accounting. Our focus is on step-by-step illustration of a problem, worked out on a whiteboard. Each topic also reviews concepts at the end if you need to brush up. Please do not forget to subscribe. The topic on long-term assets and plant assets is illustrated in 3 separate videos, namely 1. Accounting for basket purchase, also known as lump purchase, 2. Depreciation methods, and 3. Disposal of assets. Each video will also discuss the concepts after the illustration. This first video is an illustration of accounting for basket purchase. Take a moment to review the problem description. You will find it helpful to have a printout of the problem for reference, while the problem is being worked out on the whiteboard. Let us begin.
First, we are going to do the problem on lump sum purchase. Here you have to allocate the total cost paid in this lump sum purchase among the different kinds of assets purchased in that deal. Okay, so here, the information given here is company Y purchased the land and the factory building for a total of $2 million cash. So it's buying 2 properties, land and the building. And the company paid $80,000 tax, $40,000 commission, and $200,000 for inspection and closing. So here, the total cost they paid in this lump sum purchase equals the $2 million they paid for the 2 properties, plus the $80,000 they paid on the back taxes, and $40,000 paid for the commission, and $200,000 paid for the inspection and closing. So total comes up to $2.32 million. Now, the market appraisal indicates the current market value of the land is $600,000 and that of the building is $1.8 million. So here, when there is a lump sum purchase, we are going to use a technique or a tool called relative market value or relative sales value. So here, the market value so first for the land, the market value is $600,000 and the factory building has a market value of $1.8 million. So here, the total market value is $2.4 million. Okay, then based on this market value, we calculate the relative market value or sales value. So for each property, the relative market value or the sales value is the specific property's market value as a proportion of the total market value. So for the land, its specific market value is $600,000 and the total market value is $2.4 million. So $600,000 over $2.4 million comes up to 25%. And for the building, $1.8 million over $2.4 million, this comes up to 75%. So what you do is, so you will take the percentage and you multiply by the total cost they paid, which is $2.3 million, and allocate that amount to this property. So the cost allocated for the land would be 25% times the $2.32 million. So you will allocate $580,000 to the land. And for the building, you will allocate 75% of the 2.32 million. So you will allocate 1.74 million. So out of the 2.32 million, you will record the land at $580,000 and you will record the building at 1.74 million. So to record this purchase, what you do is, so this is the second requirement. So land, you debit for $580,000 and building, you will debit for 1.74 million. So they paid everything in cash. So here you will credit cash for the total of 2.32 million. So this is how you will allocate the cost to each individual property when a company makes one basket purchase, otherwise called a lump sum purchase.
Now we will review the concepts related to the accounting for basket purchase.
What are long-term assets? These are the assets that remain with the company and will be used by the company for a period more than 1 year. There are two types of long-term assets. First one is plant assets. Plant assets are the assets that are used to run the business or to operate in the business. And the second type of long-term asset is investments. These are the assets which are investments, and the purpose of having these assets is to earn extra income. In this video, we will not discuss about the investments. Again, plant assets. These are the assets that are used to run the business. And these plant assets include properties such as land, machinery, furniture, mineral deposits, buildings, etc. And except for land, all other plant assets depreciate. Now, what goes into the cost of an asset? So when the company buys an asset, the cost paid should be recorded in the asset account. The cost of the plant assets includes the price that is paid to buy the asset, any other tax, all the taxes paid such as sales tax or property tax paid before the asset is put to use, commissions paid, and other necessary and legal costs paid or incurred to acquire and make the asset ready to be used. Now, if the property is a land, then the cost will include the purchase price, the broker commission, survey fees, taxes, and legal fees, etc. It also will include any cost that is paid for grading and clearing and demolishing any junk or unwanted buildings. And all these costs that are added to the land do not depreciate. Now, if it's a land improvements, these are the improvements made above the land, such as fencing, paving, sprinkling, lawn, gardens, etc. And these costs do depreciate. The land improvements is a separate asset account from the asset. Now, for a building, if it is a building that is constructed or built by the company, then the cost goes into the building or architectural fees, building permit, contractor fees, payment for material, labor, overhead, etc. If the company buys an existing building, then the cost will include the purchase price paid, the brokerage commission, sales and other taxes, repair and renovation cost before the building is put to use. And these costs do depreciate. Now, machinery and equipment will include the purchase price, any transportation cost, insurance paid during the transportation, tax, commission, installation, and testing cost. All these costs must be incurred before the machinery is put to use, and these costs will depreciate. Now, cost allocation. Now, what do we mean by cost allocation? Or when do we need to allocate the cost? Sometimes the company will pay one lump sum price and it will buy a group of assets. For example, if a company buys a factory, it may come with the land, the building, and all the machinery inside the factory. So each asset is a separate kind of asset. So in this case, it will be a lump sum purchase. It's also called basket purchase. So a basket purchase is when one price is paid to buy a combination of different assets. And these assets will have different lives, different values, and different uses. And in this case, we need to allocate that one price paid to each of the assets that comes in this basket. So here, how do we do the allocation? First, we have this method is called the relative market value or the proportional value method. So first, the company will get the market price or the value for each asset separately. And then will divide the each value of the asset by the total market value to get the relative value or a proportional value, which will be calculated as a percentage. Then the cost allocated to each asset will be equal to its relative percentage calculated in the step above times the total cost paid.
Thank you for watching. We hope we were able to help you with an understanding of the accounting for basket purchases. The next 2 videos will illustrate and review depreciation methods and disposal of assets. We have video lessons with worked out problems on all topics of financial accounting. Please do not forget to subscribe.